Welcome to Penny Flow, where we talk about money, wealth, investing, and management. And, in today's video we will be talking about top 10 investments to make money. Please make sure you stay tuned to the end of this video. Don't forget to smash the like button and also subscribe if you're new to this channel. Top 10 investments to make money. Number 1. Stock market investment. Investing is a way to set aside money while you are busy with life and have the money work for you so that you can fully reap the rewards of your labor in the future. Investing is a way to reach a happy ending. The best way to start investing for beginners in the stock market is to place money in an online investment account that can be used to buy stock or stock mutual funds shares. An investment is a revenue or appreciation asset or item bought to make money. For example, an investor will now buy a monetary asset with the expectation that the asset will provide revenue in the future or will be sold at a higher price for a profit. You will start investing in a single share price with multiple online brokers. How much money do I need to start investing in stocks? The amount of cash you need to buy an individual stock depends on how valuable the shares are. Share prices can vary from only a few dollars to a few $1,000s. If you want mutual funds and have a restricted budget, then an exchange-traded fund, ETF, might be your best bet. Mutual funds also have a minimum of $1,000 or more, but portfolio-like ETFs, meaning you buy them at a share price, in some cases less than $100. How much money should I invest in stocks? You can assign a fairly large portion of your portfolio to stock funds, particularly if you have a long-term horizon. Number 2. Gold investment. Offering more liquidity than physical gold and more diversification than individual gold stocks, while investing in gold ETFs and mutual funds will give you exposure to the long-term stability of gold. A wide variety of holdings through gold ETFs are exposed to you. Although the gold ETFs can be a good investment, they come inherent in their custody chain with a great deal of risk. You can buy more shares to increase the sum of your investment over time. Shares of gold-oriented mutual funds or exchange-traded funds, ETFs, can be purchased by more conservative investors. Many various types of gold funds are available. Some are actively managed index funds that track market movements or bullion prices using futures or options. Selling a gold ETF will serve as a hedge. If your portfolio has exposure to the upside, it can help you hedge your exposure by buying a gold ETF. This approach is simpler and more cost-effective than direct ownership of bars or coins, especially for small investors, as the minimum investment is only the price of a single ETF share. Number 3. Real estate investment. All who purchase or sell a home is committed to investing in real estate. That means that it is important to take into account several variables. Many people do so well that they want to purchase and sell homes as a business. There are plenty of ways to do so. A house can be turned over. This is where you buy a house and then sell it to develop it. Several individuals own and rent out several houses. Conveniently, some use Airbnb to rent out all or part of their houses, using Vrbo or HomeAway for renting vacation homes. Even without buying a home, you can invest in housing. You will acquire stocks of home builders. Their stock values rise and fall with the housing market. For real estate investment trusts or REITs, another way is commercial real estate transactions occur. Their market prices lag a few years behind trends in residential real estate. There are some possible advantages to investing in real estate that is not necessarily related to other forms of investment. Through rental income, appreciation, and profits generated by business activities that depend on the land, real estate investors make money. The advantages of investing in real estate are passive income, positive cash flow, tax benefits, diversification, and equity. Number 4. High-yield savings accounts. From conventional savings accounts, high-yield saving accounts stand out in that they reward you with a higher interest rate, enabling your money to grow much faster as it sits in your account. Online savings accounts and cash management accounts have better return rates than you would get in a conventional bank savings or checking account. Cash management accounts provide greater flexibility and comparable, or in some cases, higher interest rates. The interest rate that these accounts provide is known as APY, or annual percentage yield. For short-term investments or money you need to access only periodically, savings accounts are best. Think of an emergency or holiday fund. Transactions from a savings account are limited to 6 per month. At the end of the year, $1,000 at 1% interest per year will yield $1,010 in the simplest of terms. High-yield savings account interest rates are unpredictable and may fluctuate at any time. So while a bank may advertise a high annual percentage yield, APY, when you apply, it will probably not last forever. You might be able to open a high-yield savings account where you are already banking, but only online banks also have the highest rates available. Electronic transfers are easy to create even if you keep them at separate banks between a high-yield savings account and your checking account. Number 5. Money market funds. Money market mutual funds, which are bank deposit accounts similar to savings accounts, are an investment product, not to be confused with money market accounts. A money market fund is a form of mutual fund that invests in near-term, highly liquid instruments. These instruments include cash equivalent securities, and high credit rating, short-term debt-based securities, such as U.S. Treasuries. Like any other mutual fund where investors purchase shares, money market funds run. The fund takes the capital and buys government or corporate debt in the short term, such as U.S. Treasury notes, commercial paper, deposit certificates, CDs, and so on. Your money buys a portfolio of high-quality, short-term government, bank, or corporate debt when you invest in a money market fund. Money market funds are operated to retain a highly stable asset value by liquid assets, while paying investors income in the form of dividends. Higher risk. Money market funds may invest in business paper, which is corporate debt, in volatile market conditions or if interest rates decrease. These holdings will lose value, but they can also generate more profits. Money market funds are not protected by the FDIC against losses. Investing in the money market can be very useful, especially if you need a short-term, reasonably secure place to store cash. Low returns, a lack of buying power, and that some money market investments are not FDIC covered are some of the risks involved. Number 6. Government bonds. A government bond is a form of investment based on debt, where you loan money to a government in exchange for a negotiated interest rate. Governments use them to collect funds that can be used on new ventures or infrastructure, and investors can use them to pay a fixed return at regular intervals. A government bond is a loan from you to a government agency like the federal or local government that pays interest on the loan to investors for a given period, usually 1 to 30 years. When you purchase a government bond, you lend an agreed sum of money to the government for an agreed period. In return, at regular intervals, the government will pay you back a fixed amount of interest, known as the coupon. This makes bonds an asset in fixed income, since they are guaranteed by the full faith and credit of the U.S. government. Government bonds are essentially a risk-free investment. This normally requires a promise to pay annual interest called coupon payments, and to redeem the face value on the maturity date. Bonds regularly pay interest, so they will help produce a steady, stable stream of income from your investments. Short-term bonds can be a good place to store an emergency fund, or you may need funds very quickly. If your goal is to maximize overall return, and you have some flexibility about just how much you invest or when you can invest, when interest rates are high, it is best to purchase bonds. Number 7. Mutual funds. A mutual fund is a corporation that pools funds from multiple investors and invests the money in securities such as stocks, bonds, and short-term debt. Mutual fund firms also work on licenses the same as banks, and they also require permits and have to follow due diligence before taking money from investors. A mutual fund pools money from investors to purchase stocks, bonds, or other assets. This ensures that mutual funds are as stable as banks. Many investors avoid investing with distributors. The mutual fund's aggregate shares are referred to as its portfolio. Investors purchase mutual fund shares. A fund manager, who picks all the assets in the portfolio, usually manages mutual funds. There are 4 broad types of mutual funds: equity, stocks, fixed income, bonds, money market funds, short-term debt, or both stocks and bonds, balanced or hybrid funds. Mutual funds are directly available from the firms that run them, as well as from discount brokerage companies. Number 8. Index funds. An index fund is a mutual fund or an exchange-traded fund structured to comply with some predetermined rules such that the fund can track a specific basket of underlying assets. Index funds can be especially well suited to long-term, young investors who can allocate more of their portfolio to higher returning equity funds than to more conservative investments, such as bonds. Index mutual funds are less volatile than actively managed funds that aim to beat the market, in addition to being more cost-effective due to lower fund management fees. An index fund is a form of mutual fund that holds the securities of a specific market index. Index funds also have minimum contributions, higher than those of ETFs. ETFs are more tax efficient than mutual funds. This form of investing has many advantages: lower costs, less emphasis on a fund manager's expertise, and market-wide diversification make index funds one of the best ways to invest your assets. Your money buys more shares when the index is down. Your money buys fewer shares while the index is up. After 10 years, if the total share price of all the buying points is lower than the index's current price, then you would have made a profit. Number 9. Individual stocks. When one invests in a single stock, he or she buys ownership. That person would have a percentage of ownership in that company if an entity invested in 100 shares in a public company. A stock represents a share of ownership in a company. Stocks provide the greatest potential return on your investment, while exposing your money to the highest level of volatility. A good rule of thumb for investors is to limit their stock holdings to 10% or less of their overall portfolio due to the volatility of individual stocks. If you want to buy a particular stock, it is important to understand what you are getting into. Investing in individual stocks is riskier than investing in funds, but you will be limited to a smaller number of stocks that you will be completely responsible for handling when you invest in individual stocks. The fastest and least expensive way to purchase stocks is through an online discount broker. You can pick your order form and become a bona fide shareholder once you set up and finance an account. Number 10. Corporate bonds. A corporate bond is a form of debt security issued and sold to investors by a corporation. Corporate bonds appear to pay a higher interest rate than government bonds because they are more expensive. You are making a loan to the corporation when you invest in corporate bonds, rather than having an equity stake, which you get from shares. Corporate bonds typically have a face value of 100 when sold. Corporate bonds are an ideal choice for investors looking for a stable option for a fixed but higher income. Corporate bonds work in the same manner as government bonds, except you make a loan to a company, not a government. The business gets the money at once and a pre-established amount of interest is paid to the lender in exchange. Investors are searching for fixed income protection with potentially higher returns than government bonds and are prepared to take a little more risk in return. Default risk is a big risk in corporate bonds. The investor does not collect interest payments or get his or her principal back if the issuer goes out of business. Compared to debit funds, corporate bonds are a low-risk investment option since it guarantees capital security. They typically go for an investment period of 1 year to 4 years. We have come to the end of this video. Which investment was not listed in the video? And which investment do you think yields higher revenue? Leave your thoughts in the comment. Please smash the like button and subscribe if you've not yet subscribed, and hit the notification bell so you can get notified when we release new videos.